What if I told you there's a market so powerful that it quietly controls almost everything around you? Your mortgage rate, the stock market, crypto prices, business loans, inflation, even whether companies hire more workers or start laying people off. And yet most people barely even know this market exists. It's not the stock market, it's the bond market. And if you don't understand bonds, you probably don't fully understand how the economy actually works. Because while everyone watches stocks and crypto, the smartest investors in the world are watching bonds. So in this video, I'm going to break down exactly what the bond market is, how it works, why governments are drowning in debt, and why rising bond yields are making investors nervous all around the world. And trust me, once you understand this market, you'll start seeing the economy completely differently. So first, what exactly is a bond? Let's keep this simple. Imagine you want to start a business. Maybe it's a clothing brand, a coffee shop, or a tech startup. You've got the idea, you've got the motivation, but there's one problem. You don't have the money. So you borrow money from someone and promise to pay them back later with extra money added on top. That extra money is called interest. That's basically what a bond is. A bond is simply a loan. But instead of borrowing from a bank, governments and companies borrow money directly from investors. The borrower gets money immediately, and the investor gets paid interest over time. Simple. Now, here's where things get interesting. Most people know businesses borrow money, but governments borrow money too, and they borrow huge amounts of it. Governments spend money on roads, hospitals, schools, healthcare, defense, and public services. And ideally, taxes would cover all of that spending. But in reality, most governments spend far more money than they collect. That difference is called the budget deficit. So how do they cover the gap? They borrow money by issuing bonds. That means investors lend money to the government in exchange for interest payments. Now, when people hear the word debt, they usually think it's a bad thing. And sometimes it is. But modern economies are heavily built on borrowing. The real problem starts when debt grows faster than the economy itself, because eventually the interest payments become massive. Right now, countries around the world owe record levels of debt. The United States alone owes tens of trillions of dollars, and they don't just have to repay the debt, they also have to pay interest on it, which means billions of dollars are being spent every single day just to service debt. And that becomes dangerous when interest rates rise, because the higher rates go, the more expensive debt becomes. Now, before we continue, there are 4 important terms you need to understand. First is the principal. That's simply the original amount of money being borrowed. Second is the coupon. Despite the strange name, the coupon is just the interest payment attached to the bond. Third is maturity. That's the amount of time before the borrower pays back the original money. And finally, yield. Probably the most important term in the entire bond market, because yield is what investors constantly watch. Now, this is where many people get confused. Bond prices and bond yields move in opposite directions. If bond prices go down, yields go up. And if bond prices go up, yields go down. So why does that happen? Imagine you bought a bond last year paying 2% interest. At the time, that sounded fine. But now imagine new bonds suddenly start offering 5%. Nobody wants your old 2% bond anymore unless you sell it cheaper. So the price of your bond falls. And as the price falls, the yield rises. That's why investors pay so much attention to yields, because yields reflect what the market believes about the future. Investors are constantly asking questions like, will inflation rise? Will the economy slow down? Will central banks raise interest rates? Could a recession happen? And those expectations affect bond yields every single day. Now, here's why this matters so much. Bond yields affect almost everything else in the economy. Mortgage rates, car loans, business loans, credit cards. Everything becomes tied to bond yields. When yields rise, borrowing money becomes more expensive. And when borrowing becomes expensive, people spend less money. Businesses expand less aggressively, companies hire fewer workers, consumers slow down spending, and eventually the economy starts cooling down. This is exactly why central banks raise interest rates during periods of high inflation. They're trying to slow the economy down. But if rates rise too much, things can break. Businesses begin struggling. Debt becomes harder to repay. Markets become unstable. And sometimes entire financial systems start showing cracks. Now, let's talk about who actually buys bonds. Because governments aren't borrowing from one single person. They're borrowing from massive investors all around the world. Banks buy bonds, insurance companies buy bonds, pension funds buy bonds, foreign governments buy bonds, and regular investors buy bonds too. Why? Because government bonds are considered some of the safest investments in the world, especially US Treasury bonds. Many investors believe the US government will almost always repay its debt, and because these bonds are considered so safe, they become the foundation of the global financial system. In finance, government bond yields are often called the risk-free rate, because investors compare almost every other investment against them, and this creates a huge effect on the stock market.
because investors are constantly comparing stocks to bonds. Think about it this way. Why would someone take huge risks investing in volatile stocks or crypto if they can earn strong returns from safer government bonds instead? This is why rising bond yields often hurt the stock market. Money starts moving away from risky assets and into safer ones. And this doesn't just affect stocks, it affects crypto too. When interest rates were near zero, investors poured money into risky assets. Tech stocks exploded, crypto exploded, speculation exploded, because borrowing money was cheap and safe investments paid almost nothing. But once bond yields started rising, everything changed. Suddenly investors could earn decent returns from safer assets, so money began leaving riskier markets. And that's one reason rising rates can crush speculative bubbles. Now here's something even more interesting. The bond market is often smarter than the stock market, because bond investors are extremely focused on risk. They pay attention to inflation, debt levels, economic growth, and financial stress. And historically, the bond market has often warned about recessions before the stock market realized what was happening. One famous example is something called the inverted yield curve. Normally, long-term bonds should pay higher interest than short-term bonds, because investors usually want more reward for locking up their money longer. But sometimes the opposite happens. Short-term yields rise above long-term yields, and historically that has often been a warning sign for recession. Now let's talk about one final issue, rolling over the debt, because this is becoming a major problem today. Governments constantly issue short-term debt, and when that debt matures, they need money to pay investors back. But instead of paying with cash they already have, they often borrow even more money. This is called rolling over the debt. In simple terms, they're taking on new debt to pay old debt, and this works fine when interest rates stay low. But when rates rise, refinancing debt becomes much more expensive. Imagine having a credit card with low interest, and suddenly the interest rate triples. That's similar to what governments are dealing with right now. And because debt levels are already so massive, even small increases in rates can create enormous financial pressure. This is one reason investors are becoming increasingly worried about global debt levels, because eventually countries may be forced to raise taxes, cut spending, print more money, or borrow even more. And all of those choices come with consequences. But despite all of this, bonds remain one of the most important parts of the global financial system, because they influence the price of almost every other asset on Earth. Stocks, real estate, currencies, crypto, loans, business investments, everything connects back to interest rates and bond yields. And that's why smart investors pay so much attention to this market, because the bond market doesn't just reflect the economy. In many ways, it controls it.